In the case of a Trump victory, it is more unclear because markets will be more volatile, obviously.
So the US election is the big story on everyone's mind. What kind of impact will this have on the bond markets?
Yeah, the impact of the election on the bond market is a bit unclear because if Hillary Clinton wins, it will be more or less the same policy as Barack Obama. So things would be more or less unchanged. In the case of a Trump victory, it is more unclear because markets will be more volatile, obviously. But it's very difficult to say what could become the bond market, because equity markets could decrease and bonds normally should decrease as well, but government bonds could become a safe haven. We saw recently when Trump started to climb in the polls that safe havens such as Swiss franc, gold and US Treasury rallied substantially. So maybe US Treasury could rally if Trump wins and if all risk on market collapse. In terms of bond markets globally, emerging markets could suffer a bit due to the election of Trump, Mexico in particular.
Now, talking about the ECB, there's been recent rumours of tapering. What are your views on this? Yeah,
it's a joke. It's it was an article in Bloomberg, and the ECB immediately said it's not possible. And the situation, the economic situation in Europe, is still bad. It's improving a little bit, but not enough to stop this policy. And Mario Draghi is very clear, despite the criticism of the Germans. But the economic situation in Europe is improving, but not enough to stop, and inflation is too low, and we are closer today, still closer to deflation rather to inflation. So the mandate of the ECB is very clear. It's inflation, only inflation. So inflation is very low, so the policy will continue. The problem of the tapering, it should stop in March 2017. So the question is tapering before, impossible. After, what could happen? I think that Mario Draghi could continue this quantitative easing, these purchases, but probably this amount of ECB purchases, 80 billion euro per month, will not increase. Not decrease, but will not increase. They will be stable. And I think that they will continue to implement this policy until they have a clear view on first inflation and also on growth and unemployment.
What trades would you recommend our viewers to back?
My favorite trade is still the same. It's US Treasury and long-dated US Treasury, 30-year bonds. We implemented this trade in the funds in January this year, and we are very happy with the results of this trade. And we implemented this trade in both tips, so inflation-protected bonds and nominal bonds. And in October, these long treasuries underperformed substantially. So this decrease is only temporary in our view, so it's a good opportunity to increase these positions. And obviously the problem of long treasuries is duration, because the duration is above 20. So a lot of investors are scared about this huge duration. So you can implement a trade being long 30-year bonds and short 2-year or 5-year. And being short 2-year and 5-year is also interesting because this short end of the curve will be very volatile and very, very dependent on the Fed behavior in the coming months.
Well, thank you for joining me in the studio once again. It's been a pleasure.
Thank you very much.
And thank you at home for watching. Don't forget you can catch previous interviews by clicking on our channel. Goodbye for now.